the danger of Division 7A loans as a business owner. If you've been in business for a while, you've potentially heard the idea of a Division 7A loan or a related party loan. Maybe it's even called a beneficiary loan. It's often a situation that many small business owners get into when either they've got really bad tax advice or they've got really poor cash flow structure. I'm going to explain to you what a Division 7A loan is, how you might find yourself in hot water, and how to handle it moving forwards to make sure that you can build wealth and create a valuable business into the future. So, when you're running a business, most of us want to get to a point where we can draw dividends out of our business. And typically speaking, a dividend is a profit distribution. That means that the business that you have is profitable, and typically that means that it has paid the company rate of tax on that profit. And when that is distributed, you obtain what's called a franking credit. So basically means that you get a credit for the tax that has already been paid in your company, meaning that depending on your individual tax rate or the entity that you distribute it to, you will pay the difference or potentially even get a refund. Now, for many business owners, the first issue arises around Division 7A loans is basically that throughout a year, if you have not reached the end of the financial year and you have not done your financial statements and tax returns, a profit cannot exist. It essentially means that if you've taken money out of your business, it must sit on your balance sheet, essentially in preparation for a profit to exist and then a decision to be made in terms of how those funds are going to be dealt with. Now, if you want to have access to those funds in between, there's nothing wrong with that. You take that out. And that sits by way as a related party loan or a director's drawing or a director's loan on your balance sheet. And at the end of the financial year, a good accountant will normally say to you, hey, well, you've taken this money out of the business, or maybe you've run personal expenses through the business and we need to treat them as a related party loan. What do you want to do with them? You either pay the money back. Well, I've spent the money. Okay, well, we can distribute it as a dividend, but you're going to have to pay this tax bill. Oh, well, I haven't put any money aside. Well, third option is that we kick it down the road. Let's do that. And that's what most business owners do. They end up taking what's called a Division 7A loan, which basically is borrowing money from their business that has not been deemed as a distribution. Now, they are required to pay back that over 7 years at a deemed interest rate. And ultimately, that needs to be paid back with principal and interest repayments over that period of time. Sounds pretty harmless, right? Well, what are the issues? Well, the first issue is that the interest rate is now over 8%. Based on inflation and the current cash rate. And sure, you're taking money from one hand and putting it into the other, but as a result of doing so, that income is now going to be taxed. And what this does is that each year, it forces you for the interest that has been paid and also for the principal component of that loan that is required to be paid out, it forces you to distribute that out in the year that is paid, and it does not receive a franking credit, which basically means that you now need to pay all of that tax as an individual. Now, at a relatively small level, let's say it's a couple $100,000 that you've done, or you've done it for a year or two, not so big of an issue. But what we typically see is that this is a strategy that many small business owners and without the proper guidance of their accountants continue to do year over year over year, which can exacerbate into, in some cases, millions of dollars. We've seen some individuals whereby they have accrued a beneficiary loan account of upwards of $4 or $5 million. And you can imagine 8% interest on that, principal interest repayments over 7 years. There's some pretty hefty tax consequences associated with this. And for that reason, it can be a strategy that can be very dangerous and it can create some solvency issues. Now, there's nothing inherently wrong with the Division 7A strategy in isolation, assuming that it's being used appropriately. For example, we can use company profits. Let's say that you'd accumulated $1 million in profit in your business. You could do a secured Division 7A loan over 25 years. And it's a great way to get money out of that business without you having to pay the top-up tax. But then you've really got to evaluate the opportunity cost of the tax that you're going to pay along the way, interest, so on and so forth, to really evaluate the benefit, particularly when the interest rate is now over 8%. The greater issue here is that it's really typically, for most small business owners, a means of them getting more money out of their business so they don't need to pay the tax. And what this means is that this is fundamentally a cash flow issue. And by kicking the tin down the road, unless they get to a position where their cash flow substantially improves in the future, it is only going to make a bigger problem. In other words, if your plans, goals, and aspirations don't afford you the opportunity to pay that extra tax right now, why do you believe that at some point in the future that is going to change? It's a blatant speculation that I see so many business owners doing. So what should we do instead? Well, For my clients, what we focus on is actually completely removing the idea of Division 7A loans from the business. We treat everything as if it is going to be distributed. We make sure that we've got the appropriate tax structure. We use the benefits of trusts and bucket companies in order to optimize our tax rate. But any money that we pay out of your business, we do so on the basis that we believe it is going to be distributed as a dividend, and we make sure that we apportion the appropriate amount of tax for that. But the idea here is that cash flow is all about making sure there are no surprises. If you factored it in and you can achieve all of your goals, factoring all of the tax consequences in, it doesn't really become much of a problem. The biggest issue for the vast majority of business owners that I work with, they find themselves in a tax issue because they don't have a sustainable business model, or secondly, they have not prepared for those tax consequences, so therefore it becomes a surprise, and ultimately they've spent the money by the time the bill falls due, and then they find themselves in hot water. So if you're watching this video and you're wondering what you should do, well, the first thing you should do is that you should go and have a look at your balance sheet. Go and see, have you had a director's loan? Do you have a Division 7A loan or a beneficiary loan that exists in your business at the moment? Secondly, is your accountant being proactive with you in order to manage this liability to ensure that you have the appropriate plan in place to manage it? Because as I mentioned, in isolation, it's not so much of an issue. It's just ensuring that you've got the appropriate plan in place to support it. And thirdly, have you reviewed your financial operating system and the way that you manage your cash flow in your business to ensure that you are not just using a Band-Aid solution to kick the tin down the road and inevitably you are making the problem worse for yourself? If you want some help with that, feel free to let me know. If this has been helpful, drop it in the comments, drop us a like, drop us a follow. And if you've got any questions about tax, planning, and how to improve your cash flow as a business owner, let me know.